Simply economics, big ideas made small. Everyday money talk for any mind at all. Simply economics, learn fast, feel smart. One quick listen and you're ready to
Have you
start.
ever been wandering down a street, maybe in a new city or just around the corner from your office, and you get that strange sense of déjà vu?
Mm-hmm.
You pass a great little local coffee shop, and then, I don't know, a stone's throw away, you see another one.
And then another one right next to that.
Exactly. And you start to wonder, why? Why are they all clustered together like this?
It's an almost universal experience, right? It
Yeah.
feels like we've hit peak coffee shop. And if you're, new to economic thinking, you might wonder, is this just random, a cultural thing?
Or is there some deep underlying economic rule that sort of guarantees this is going to happen?
And that's it. There is.
That's really the question we're tackling today. We look at this and it seems to defy logic, but what we're going to show you is that this pattern of businesses popping up and disappearing, it's actually a fundamental classic story of economics.
It's not chaos at all. It's pure self-regulation playing out in real time.
Okay.
So our mission today is a deep dive. We're going to look at how markets respond to maybe the most powerful force in economics: incentives.
We'll lay out the core concepts, right? Market entry, competition, and then how it all settles into this fragile piece.
Yeah, what we call equilibrium.
And to make this really stick for you, the learner, we're going to use this hypothetical setting from our sources. Let's call it Coffee Town.
I like it. So think of Coffee Town as any high-demand area. A downtown core, a college campus.
Anywhere that needs its morning caffeine fix, we're going to track the entire life cycle, from just a few shops to, well, saturation.
And that journey, it always starts with the pull of money.
Okay, let's unpack this, starting with the fundamental question that kicks this all off. Why does Coffee Town keep attracting new cafes, even when we as customers feel like there are already plenty of options?
The simple answer, the engine for almost all of this, is profit.
Right.
But we need to be really specific. In the beginning, when Coffee Town only has, say, 2 or 3 cafes, they are making what economists call economic profit.
So this isn't just, paying the bills and making a decent living. This is something extra.
It's way above that. It's an excess return. They're busy, the lines are long, their prices are strong, and the owners are just seeing huge margins.
And that success, it doesn't happen in a vacuum, does it?
Not at all. It sends out this powerful signal. It's basically shouting to the rest of the market, hey, there's a gold mine over here.
Demand is way higher than supply.
Exactly. That's the signal.
So who's listening to this signal? It's not just someone who likes making lattes, I assume.
It's a whole spectrum. First, you have your entrepreneur who sees those long lines and thinks, you know what? I could serve half those people.
I could do that.
Then, and this is crucial, you have the capital, the investors.
Banks, venture capitalists.
Right. They see the numbers, the potential return on investment, and they are more than willing to fund a new venture because the payout looks so good.
So it's that mix of ambition and available cash that really causes the boom.
And suddenly 3 new shops open at the same time because the numbers seem to justify the risk.
And there's a term for this, right, for our learner audience.
Yep. We call this market entry driven by profit incentives. It is the absolute foundation of growth in a competitive market. Those high profits are the bait.
And the entry of new businesses is the inevitable result.
Mm.
This is where it gets, for me, really interesting, where the market starts to almost turn on itself. So we've had the gold rush. Coffee Town now has, say, 12 cafes instead of 3. What happens now that it's just flooded with supply?
The whole dynamic flips instantly. As all these new places open, the supply of coffee just increases dramatically.
But the other side of that equation, the demand side, doesn't keep up.
Exactly. The number of people who want coffee doesn't just triple overnight. We might love coffee, but, we still only drink a cup or 2 a day. Our demand is pretty fixed.
So all those customers who used to be in one long line are now spread out across a dozen different shops.
Which means every single business, old and new, sees its foot traffic drop.
And this is where the costs of running a business like a cafe become so important. You have these huge fixed costs, don't you?
Massive. Think about it. The rent is the big one. You pay the same rent whether you serve 10 people or 1,000.
And the loan on that fancy Italian espresso machine, the manager's salary, it's all locked in.
Right. So when your traffic drops, you're still carrying all that overhead. And you can't just sell more coffee to make up for it if people aren't coming in the door.
So with fewer customers and these high fixed costs, I'm guessing a competition gets pretty fierce.
It gets brutal. This is where the price wars begin.
Oh.
Every owner is thinking, if I can just steal a few customers from the guy next door, maybe I'll make it through the month.
And that forces prices down. This is when we start to see the deals, right?
The buy one, get one half off, the aggressive loyalty cards, $2 Tuesdays, those are all distress signals.
It's businesses fighting tooth and nail for a shrinking piece of the pie.
For sure. So the core rule here is really clear. More supply leads to stronger competition, which leads to lower prices.
And that immediately crushes those big profit margins that started this whole thing.
The market is naturally correcting itself. And for a little while, it's actually great for us, the consumers.
We get cheaper coffee.
Cheaper coffee, better service, all because of this desperate fight for survival.
So let's talk about the end game. When does this all stop? When does opening a new coffee shop finally become a bad idea?
That happens when Coffeetown reaches what we call market saturation. This is where the environment goes from just being harsh to being, well, unsustainable for a lot of players.
The profit squeeze is total at this point.
It is. The costs, like you said, are locked in, rent is high, but because of all that competition, you can't raise the price of your latte. You're trapped.
So those big economic profits from the beginning, they start to shrink.
They shrink, and then they vanish completely. And what you see is the market splitting into two groups. The best run shops are maybe just breaking even.
And the weaker ones are now actively losing money.
Right. And once the expected profit for a new shop falls to zero or even negative, the incentive signal just flicks off.
The magnet is gone. No smart investor is going to put money into a business that's only projected to break even.
And that right there is the moment of stability. This final state is what economists call long-run equilibrium.
Okay, let's define that because it sounds a bit technical. It's a state defined by the absence of those unusually high profits, right?
Exactly. You're only left with what we call normal returns.
But normal return doesn't mean the owner is making zero money, does it? That sounds confusing.
No, not at all. And this is a really crucial concept. A normal return means the owner is earning just enough to cover all their costs, rent, wages, beans, and cover their own opportunity cost.
What they could be making if they were doing something else.
Precisely. If that owner could earn, say, $80,000 a year managing someone else's shop, their own business has to pay them at least that much, plus a return on their investment, just to make it worthwhile to stay open.
I see. So when a market hits equilibrium, it has zero economic profit, but that just means everyone is being compensated fairly for their time and their risk, not that they're working for free.
That's the balance point. If they earned more than that, new people would enter. If they earned less, people would start to leave.
It's like a truce that's been reached through competitive exhaustion.
That's a great way to put it.
So let's put ourselves in the shoes of an entrepreneur. What are the actual real-world signals they're watching for? What tells them to get in or, maybe more importantly, get out?
The signals are super practical. For anyone thinking about market entry, they are looking for clear signs of unmet demand.
Like the obvious stuff. Long lines out the door of existing shops.
Long lines, people complaining about the wait. But beyond that, they're digging into the financials. They're asking, what are the profit margins here? How fast can I get my initial investment back?
A quick return on investment is basically a green light.
The clearest one there is. Then once the market gets saturated, the signals flip. These are the exit signals.
Okay.
Most direct one is just continuous financial losses. Your bank account is shrinking every month. You aren't even making that normal return we talked about.
And tied to that, I imagine, is just seeing fewer customers, empty seats during rush hour.
And realizing you have to run a 30% off special all the time just to get people in the door. Those are huge red flags.
So those signals force a big decision for the weaker cafes.
A critical decision.
Yeah.
And they really only have two choices based on these principles.
The first one being to innovate.
Yes, the heroic choice. You have to find a way to escape the price war entirely by changing what you offer.
So you're not just selling coffee anymore.
You can't be. You have to offer something unique. Maybe it's branding, an incredible customer experience, special single origin beans, something your competitors can't easily copy.
You're creating your own little mini market where you can charge more.
You're competing on value, not on price.
Yeah.
But that's hard. It takes effort, and it often takes more money.
Which leads to the second, less heroic choice.
Which is to exit.
Yeah.
If you can't innovate, if the location is wrong, if the money runs out, You have to close down.
You leave the market, freeing up that space and that capital for something else, a yoga studio maybe.
That's the painful but necessary cost of how a market becomes efficient.
So that's the full cycle. It's elegant and a little brutal, but shows that the businesses we see coming and going aren't random at all.
Not in the slightest. They are purely logical responses to financial incentives.
Okay, so the key takeaway from this deep dive really is that high profits attract competition.
And that very competition pushes profits back down to normal levels. This self-adjusting process is really the heart of how competitive economics works.
And it explains everything. It explains why your street looks like a gold rush for coffee shops one year.
And has a bunch of empty storefronts the next. It explains the appearance and the disappearance.
Okay, so a final thought for you to take away from this.
Now that you get this cycle entry, price war, innovation, or exit, start applying this lens to other businesses you see every day.
Don't just look at the coffee shop.
Think about nail salons, or those quick-serve sandwich places, or the Boone and fitness studios.
Observe the signals. Don't just look at the prices. Look at the lines. Is one sandwich shop charging 25% more than its neighbor?
And if it is, ask yourself why. What are they doing differently? What value are they providing that lets them escape that brutal price competition?
You can now see these dynamics at work on basically every commercial street in your city.
It's all about incentives.
That brings us to the end of today's episode of Simply Economics. We hope this discussion helped make today's economic concept clearer and more relevant to real life. If you found this episode useful, feel free to share it with others who are interested in understanding economics beyond the textbook. You can find Simply Economics on YouTube, Spotify, and Podbean. In our next episode, we'll continue exploring how economic theory applies to everyday decisions and real-world markets. Thanks for listening, and we'll see you next time on Simply Economics.